I've kind of touched on some of these in terms of other challenges in the U.S., but I think with the U.S. still the biggest single global economy, it's essential for some kind of global economic recovery. Static will allow those other countries to bring some growth to the world economy, but any kind of continuing shrinkage on the U.S. after a quarter of uptick would clearly be detrimental. I'm not a commercial real estate expert, but everything we're looking at suggests that commercial real estate is continuing to get worse. Cap rates are rising. I'm not sure risk-adjusted capitalization rates for valuing real estate are as high as they need to be. Understanding is they're in the high single digits, but if you can't finance and your rents are going down, what's a decent cap rate on real estate? A lot of the regional banks continue to be extremely challenged because of the loan problems and residential, most often in terms of home equity loans and that sort of thing that they build on top of the core mortgages, and because of the growing problems in commercial real estate. Job creation's not there yet. You see these responses to declines in the weekly unemployment numbers from 590 to 570 or 550,000 per week. It's important to understand that anything more than 400,000 still means the U.S. is losing more jobs than it's creating on a weekly basis. And to really get the economy growing and to claim that there is some net job creation in the United States requires a number in the 300,000 to 350,000 range. So how good is a green shoot that's gone from 590 to 550 if you're not even at break even until you get to 400,000? And lastly, the baby boomers are getting older. And as they get older, they tend to spend less money. They get more conservative, decide they can make do with the same car or the same house for a little longer. They're not going to be the drivers. They're the net savers. They're the ones with the best balance sheets, but quite frankly, they're not going to push this economy forward. The massive accumulators that tend to be demographically in their 30s and 40s are the ones that leveraged up worse than most, and it's our sense as a result that those who would drive the economy forward have too few bullets in their gun, and those with the bullets in their gun are going to simply stay home. In terms of global challenges, I mentioned earlier a concern about overstating the assumptions about Chinese growth. This information is not easy to get because it's not simply readily available from China yet. The Chinese do not measure GDP the same way we do. We have a system that's capable of measuring GDP based on the fact that they can measure all of the retail sales, ultimately what product goes to the consumer. The Chinese, because they don't have robust enough statistical gathering capabilities yet, end up basing their GDP based on the amount of productivity that is shipped out to somewhere. Presumably the consumers, but mostly to the stores or whatever intermediate stages that exist. As a consequence, they can stimulate, they have accelerated loan generation at a tremendous rate, I think roughly 400%, with the $570 billion stimulus package that they announced a year ago. But if you spend enough time trying to gather these small data points that are out there, it's apparent that companies, many of whom are still state enterprises, are producing product that the consumers may or may not really want in China, and GDP growth may, as a result, not be as good as people think it is over there. The concern we have is that if, in fact, the Chinese don't show up on schedule, most of the markets have rallied extensively to this point in the belief that they will lead the rest of the world out of recession. And if they don't show up on schedule, we will retest some of our comfort zone about valuations in the 1,000, 1,050 range for the S&P. I mentioned the fact that the baby boomers aren't ready to spend. The larger demographic question globally is that Europe, Japan, and the United States are all demographically evolving as countries that have very high transfer payment obligations, whether it's health care, whether it's social safety nets, or whether it's Social Security retirement funding. All of these countries are seeing a shift in the shape of their demographic distribution to a steadily older and more demanding, less contributing kind of mix. Japan and Europe didn't have baby booms, as many of you I'm sure know, because after World War II they weren't in a position to do so. We, the Canadians and and I think the Australians did. The U.S. still has the luxury of most of the baby boom population younger than me, because I was born early in '49. So we still have a working population that's fairly healthy and fairly savvy. But when you look at Europe and Japan, they're quite a bit older. And the percentage of their people that are approaching retirement age or in retirement age is going up very fast. Their birth rates are very low. They don't have the catalyst to push the economy forward, the world economy. So what happens is psychologically everybody starts leaning more and more on the assumption that China and India will solve the problem. And I think ultimately, because they are so dependent on selling to us and we're not buying, the idea that China's growth and India's growth will be dramatically better than it has been in the past, or even as good, may be open to question. The next few months will be very interesting as we get a better understanding of what's really going in Chinese economic statistics. MIT has a laboratory within their business school, which is quoted in the most recent Forbes magazine, to the point that it's really not clear from some of these statistics how fast China is getting better, and how much of this bubble in commodities isn't ultimately driven by loans to enterprises in China that are then turning around and buying either real estate or commodities because they don't really have any product to sell. They don't have any customers who want to buy it. China does not have a social safety net. Consumers there are very conservative. They tend to carry little or no debt, at least traditionally they have. And as a result, without that comfort zone, they're not likely to just open up their wallets and start spending liberally. So how do you invest in this environment? I think you start out by being sensitive to timing. I've not seen a market in all the years I've been doing this where the major phase changes in an asset class come as fast as they're coming right now, as everyone tries to jump ahead of whoever else is in the game. High yield bonds were compelling as investments at the end of last year. We sent one of our communications, the clients talked about that. At this point, I think you got to sell your high yield bonds. They have come down so far in yield. Normally, you wouldn't think about flipping high yield bond portfolios in 8 months. But these things are happening so fast. 60% moves in emerging markets, that's where the future is. But do you really want to buy after a market's up 60%? It's actually up more like 80 if you go back to their bottom in the fall of last year. So we think it's too late and therefore too risky to chase a lot of those markets that have been the best performers. We don't favor broad index plays. The broad indices reflective of money flowing into ETFs and other kinds of categories are probably more critically dependent on the assumptions of economic growth than individual rifle shot kinds of investments. We'd encourage people to size up their current portfolios, shave off all the dead wood that you can find. Don't own things that are low quality with the luxury of having had such a marvelous rally in the last 6 months. It's hard to go to cash when you're paid nothing for cash. But on the other hand, don't own anything you have any doubts about, I don't think, at this point. Look for entry points to come back in. That's how we're approaching it. We run several different asset classes. The one that's most dear to my heart is small value. We tend to call it roadkill with a pulse, excuse the Western agrarian metaphor. We're a deep value buyer. Those stocks got decimated so badly in the fall of last year as hedge funds melted down and everything else unraveled that in some cases they're trading at probably 20% of what we think their intrinsic value is. A lot of these stocks have doubled or more since then. We think there's still 50% to 100% upside in a lot of those kind of companies. Now, given our prior speaker, I'm going to be really careful to make sure that I disclaim that is not a prediction for our portfolios. But there's still a lot of dislocations, and if you're selective picking those dislocations, I think there are chances to make some money.